Well, welcome, David. It's great to have you here.
Thank you, Gary.
No problem. This is our second podcast that we're doing in a little bit of a series where we are talking about different topics to do with angel investing.
Yes.
There's a lot of people that need some education locally about angel investing and have been asking specifically for this topic about SEIS and EIS from a new angel perspective and even from a founder perspective as well. So we'll dive into it today with some questions.
Sounds good.
If that's all right. So just to start us off, David, so you're known locally, and I always describe you as the SEIS and EIS king here locally for questions about the scheme.
No kings, Gary.
If we could just get a little bit of background on how you got into this world and just a little bit about support that you can give for founders and potential angel investors as well.
Okay, sure. Well, thanks again for inviting me. It's a good opportunity to speak to people and to spread a bit of information about these topics, because I know, as you say, there's a lot of interest here and potentially a lot more companies that could be helped and get more information and money, of course, and investment. So that's what we're all keen to see. So from my own perspective, I came by a very circuitous route. I started off doing a PhD in French literature, and as there weren't a lot of jobs in that, funny enough.
I didn't know that. Okay, cool.
Yeah, I ended up becoming a tax inspector.
It's a big change.
A very big change, yeah, indeed. And after that, I went into private practice with one of the big four locally accountancy firms. And following that, pretty much a 14-year stint there, doing lots of tax work. I went out on my own and very quickly kind of got into at that stage, sort of fairly early stage of people networking and the early days of the angel networks and so on, and got more and more involved in that because I was surrounded by, where I was based was an office with lots and lots of startups and early stage companies, and we all worked with each other, and that was a very good, healthy environment to be in, as you will well know. And sort of from there, I became more and more interested and more and more involved. And yes, I mean, at this stage, it's in the hundreds of examples of cases I would have been involved in where people have been, companies have been getting tax advantaged investment, as we might call it.
Brilliant. Okay, so let's dive in. Let's talk about the particular schemes that we have. Our region has one of the most kind of beneficial tax breaks for investing in startups. So if we talk a little bit about SEIS, EIS at a high level and what that means, would be really beneficial as a starting point.
Okay, sure. Two great schemes. SEIS is the Seed Enterprise Investment Scheme, and it does what it says on the tin, if you like, in that it's meant for companies getting their first external investment, and so there are quite low limits, if you like, on that, but the tax breaks, as we'll hear in a minute, are excellent for investors taking part in that. It's big brother sister, if you like, is the Enterprise Investment Scheme. There's been a version of that around for at least 30 years, probably longer. The SEIS scheme is more recent, but it's still already about 11, 12 years old, I think, at this stage. And between them, they've brought in massive amounts of money to companies needing investment from the outside. So SEIS, to start with that, is the two schemes, I should say, are on very similar lines. EIS was built and tweaked over the years, but hasn't actually changed that much because it works. And so SEIS was then brought in for that extra bit at the start when companies really needed a leg up and had exhausted maybe their own funds and family and friends and needed to look a bit further afield. And the idea behind them is to get new money, if you like, into companies. So it's probably worth starting with, the three interested parties and what's in it for them, if you like. So there's really treasury. Why do the government give people tax breaks for investing in companies? And the simple answer to that is it stimulates the economy. It by giving these tax breaks, it encourages people not to put them in safe havens or big multinational companies where the shares are only going to move, a point or two or whatever. You're not going to get passive returns. You might get nice dividends every year, but it's not going to change your world, and it's certainly not going to change their world if you put even 100 or a couple of 100,000 into their shares. For a start, doesn't go near the company if you do it that way and buy them on the FTSE. So it's a way of getting new money into companies. From the Treasury's point of view, it stimulates the economy. It's part of that whole package of things they do, like R&D tax credits and so on as well, just to try to get things moving and get new and emerging technologies forward and bring new and younger people or people with new ideas coming out of a career in working for someone else to be able to start their own businesses, build those businesses, and earn lots of import monies, tax, etc. for the country. So that's the government's take on it and why they would give up tax for that reason. Second one is the company. Why, as a company, would you want to avail of these schemes? And the simple answer is it's a great carrot to be able to put in front of somebody to say, if you invest in my company, you will get significant tax breaks. And I promise I'll explain in a moment what those tax breaks are. And it's also a way, if you like, of getting beyond that. The classic thing is, as you and I will both have seen lots of times, is where people will use their own money. They'll go to friends, they'll go to family, and they'll get money in. And if they just take money on normal terms, nobody's really getting a great tax benefit from that. And if you go beyond that, a number of good things happen. If you get new money in from external investors, you can then leverage that to get grants. You can use that to get match funding from government agencies and so on. So there's lots of good things that this money stimulates for the company. And as well, it means you're not having to go to friends and family all the time. Yeah, exactly. So I'll come back to that in a moment because there's an interesting point about that. Third one is the investor. What's in it for the investor? And so SEIS is a jaw-droppingly good tax break. If I put £1,000 into an SEIS company, I can usually within a few months get back 500 of that, 50%, as an income tax relief. So it doesn't matter what rate of income tax I'm paying, as long as I'm paying at least £500 of income tax, I will get that back. So straight away, my investment has only cost me £500, not 1,000. But the company has £1,000 that it can go and get potentially more investment from other people, from grants, etc., as I say. So that's good enough in itself. After 3 years or more, if I've still got those shares and I then sell them, let's say I happen to find the next Google or something, and I've invested in it very shrewdly at the start. I'm still looking for that, by the way. But if that happens, I can come back to that more than 3 years later, sell my shares, absolutely no tax. So I've still got my 500. They don't ask for that back. Absolutely tax-free. And there are other things as well. For example, with SEIS, you can actually increase the money you get back if you've got a capital gain. You can potentially get half of that tax back. So there is a situation where somebody can go in now to an SEIS investment, and within a few months, they've got back 62% of their money. So their risk is already limited to 38% of the investment. Yeah. Which sometimes when you tell people this, the jaws literally do drop. They just can't believe how good that is. EIS is moderately less generous, but same sort of structure as I say. So same capital gains tax-free exit. With EIS, there's an opportunity to hold over gains rather than save money on the tax at the time, so you don't pay any tax. You can kick that into the future, potentially indefinitely. The tax break under income tax rules for EIS is 30% on the initial investment, and both are after 2 years an inheritance tax shelter, which hopefully doesn't really worry most of us, but at some point it will. It'll come to everyone. So there's a lot of tax benefits that spin from that. So you can see why for an investor who wants to take a risk and also who wants to go into something that might actually have a stratospheric takeoff, a multiple return on their investment. That's what any kind of investor ideally is looking for, something that's got downside protection, which this has, because as I say, in some cases, you're only risking 38% of your money up front. There's further loss relief if it does go all wrong, by the way, even on that. But, if it does go well, tax-free exit, and no matter how high the sky is for that particular investment, no tax when you come out.
Yeah, it's mad. It's really mad. So it is. So maybe just on maybe the two things there. So one, talk a little bit about the loss relief side of things, because that's where it can kind of obviously ramp a little bit more. And then two, what are the actual thresholds for an angel investor on limits that they can do for both schemes? And then we'll flip to the founder side.
Absolutely. Okay. So in terms of the limits, an individual investor now can put up to £200,000 in a year into SEIS companies, and up to £2 million in a 12-month period into EIS companies. And as long as you've got the sort of you're paying the income tax to get the benefit of that, you will get the full 50 and 30% reliefs. And you can do that over a period of 2 years. So it's the year of the investment itself, by which I mean the year that the shares are issued, the tax year that the shares are issued, and the year before that. So very often an investment can be used to cover tax that's either coming due or has already been paid. And you can actually either get a repayment or avoid having to pay tax. So that's really useful for the company. The way it works is the limit is £250,000 for SEIS, and it must come in as the first investment really that comes in, and it must come in before the company has been operating for 3 years. Once that deadline passes, or you've used up your 250,000, and I should say there are some restrictions on that. For example, the employment allowance for national insurance comes off that limit, because it's treated as kind of de minimis state aid or equivalent. For EIS, the limits are bigger. You can, as I say, as an individual, invest up to $2 million a year in knowledge-intensive companies, and the company can raise $5 million, or indeed for a knowledge-intensive company up to $10 million in a rolling 12-month period under EIS rules. So they really are for virtually all of the companies. Certainly the companies I would come across, those allowances are pretty generous. You know. So the first part of your question, so I'm going to
the loss relief side of things.
Relief.
Yeah, the loss relief.
Loss relief. Okay, so nobody gets into investment to talk about losses, and it's probably a good point to say.
Yep.
This is not investment advice.
No, it's definitely not.
Not entitled to give investment advice. As regards loss relief, there's further what we call downside protection on your investment. So if you invest in a normal company, let's say one of the big ones that are quoted companies, and you potentially lose all your money if that company goes under. Very unlikely, but that's a possibility. In this sphere, because there are more risks, there are issues, there are things that happen, things change, technologies get out of, grow very quickly and change very quickly. So there are things that happen, let's be honest about it. So if that happens, on an investment, let's say an SEIS investment of that £1,000, I've got my 50% back up front, but they come back to me and say, unfortunately, David, we've had to close the doors. We haven't got any money for you. So my next step is, well, how do I claim back loss relief? And I can do that by getting a tax return and filling in that I've lost money on these SEIS shares. Okay. And I get relief at my marginal tax rate. So that's 50%, that £500 in this case that I have lost. If I'm a 40% taxpayer, I'll get another £200 tax relief on it. So, even in a sort of worst case scenario, if you like, I have actually lost £300 of a £1,000 investment, and that's an absolute worst case scenario, really.
Yeah.
So again,
It's crazy
Very
when
good,
you think about it like that. When you simplify it in those kind of numbers, that they're really the risk is so low actually. So it is once it goes through. Okay, so you've kind of highlighted a few things there from an angel capacity. Let's flip to the founder side, and you've mentioned a few things about why it's important. That first step of money and whatnot. When should a founder think about SEIS and EIS and go through that particular process? Because there's a process that we've chatted about before. So when should they think about doing that?
Okay, so you know what they say, knowledge is power. And the earlier you have that knowledge, the more powerful it usually is. So I think it's a good idea for people to find out about it. And it's not hard to find out about it by asking the likes of me, for example.
Nice plug.
And there are lots of sources out there of information, and the important thing is find out about it.
Yep.
And then you'll know what the pitfalls are. Most startup companies are very likely to qualify. So, and I should say, and maybe it's because I was a tax inspector way back in the day, or maybe it's just because I'm fair-minded, but this is one of the things where the revenue actually don't try to trip. They really don't try to trip people up. It's the opposite. I'm not saying they normally do, but you never get the feeling with the revenue that they're trying to catch you out in this. Yeah, which I think some people do feel sometimes when they're dealing with the revenue. To be fair, in this case, there are people who are they know that their task is to encourage investment, is to make sure that people know how to do it, and to try to operate the rules in a fair way, a clear way, and to get things done quickly. And the turnaround times, for example, I'll get onto that hopefully in a minute, but the turnaround times can be really lightning fast on these things. Not always, of course, but where they can, they do their best to help. So, it really is a kind of supportive environment. So finding out about it early, absolutely essential. The actual approach to the revenue doesn't need to happen until close to the time of the investment. And that again, a few years ago, things were getting a bit stuck. The revenue said, look, we're getting too many speculative applications from people. We only really want to see the ones that are about to happen. And if you do that, if you only bring us the ones that are, on the threshold of investment, we'll turn them around really quickly. And that works most of the time very well. So maybe time to talk about the process.
Yeah, let's go.
So
talk about the process.
There's really 3 stages from the company's point of view, and it is the company that leads this process. So let's say I'm a founder who wants to get investment into my company. I've spoken to several people. They're interested. They love the sound of the tax reliefs. And now it's up to me to actually get that sorted out. So what do I do? First thing is I don't have to, but it's a good idea to apply for advance assurance from the revenue. So that's an online form. It's not massively hard to fill out, but obviously I would suggest it's a good idea to get somebody who is familiar with the process to do it. And by the way, Intertrade Ireland have a program whereby they will pay for companies who fit the bill to pay 100% of the fees to get the advance assurance secured for a company. So,
and you're included in that, aren't you?
I'm included.
There
in
we
that,
go.
Absolutely.
Good.
Yeah. So, strangely enough,
of course,
not entirely altruistic. No, I'm included in that. So that's one of the ways of doing it. As I say, it's not mandatory, but it's a really, really good idea, especially from the investor's point of view, because it's much more likely people are going to transfer that money into your solicitor's account and ultimately your account if they know that they're going to get the tax reliefs. Yeah. And so advance assurance is a way of going to the revenue. You need a few things that you should have anyway. You'll have set up your company, you have your articles of association, whether they're model articles at that stage or not, that's fine. You'll have your UTR, your tax reference for corporation tax, and you'll have a few other things, hopefully, like a slide deck, a business plan, perhaps. Financial projections, absolutely vital for this. And you take those to the revenue and say, if we get this much investment, will our investors qualify for SEIS and or EIS reliefs, depending? And the answer hopefully is yes, because if you've taken the right steps and got the right advice, that's a bit of a penalty kick. So next stage is when the investment happens. You actually have to go back to revenue. If you've done advance assurance, that's a lot easier. You have less paperwork to supply, and you have less details other than just saying, here's the people who invested, here's how many shares they got, how much they invested, the date it happened, and then the revenue will hopefully very quickly issue an authority for the company to issue tax relief certificates, which are known as SEIS 3 and EIS 3 certificates. And you take your 3 certificate to your accountant or attach it to your self-assessment or whatever to get your tax relief. So there's a number of ways in which you can get the tax relief, as I say. I'll come back to those in a moment, hopefully. But in terms of the actual process, it's driven by the company. I literally last week got back the EIS 2 authority, which allows the company to issue the EIS 3 certificates less than 24 hours after we submitted the online form, the compliance statement.
That's great.
And funny enough, for the same company previously, whenever we submitted the advance assurance, it was the same story. We literally got it back within 24 hours, which is, I can't guarantee that. It's not a magic formula, but it shows you that when they can, they will, you know.
Yeah. So just on that piece, is there any restrictions from a company perspective that is applying for advance insurance or trying to get SEIS? Is there any particular verticals or type of company that it doesn't apply to?
Okay. So I think in a way it's easier to say there are so-called excluded activities.
Yep.
And as long as it's important for a company, SEIS is peculiar in the sense that it has to be a new trade. So that's an important point. You can't really kind of, go, oh gosh, our company's been running for 4 years, let's set up a new company and start again under a new guise.
Yep.
If it's the same trade, that's not going to work for SEIS.
Okay.
But if you are doing something new with IP, for example, that you're working in a different way under a different brand or whatever, different sector, then that probably will qualify, There are excluded activities. The obvious ones are things like energy generation, the banking, accountancy and tax and things like that, unfortunately. Damn them. So, there are certain things, but actually that range is pretty narrow.
Okay.
And it's easier to say, that most companies are likely to qualify. Anybody in the sort of the fintech space. I mean, to give you an example, a few years ago, there were quite a lot of peer-to-peer lending platforms being set up.
Yeah.
And, if you write that in one way, that's kind of like a kind of banking activity, a financial activity.
Yep.
But if you're using a platform, which is how you matchmake the potential lenders and the potential borrowers, it's actually, a software solution, a platform.
Yeah.
And those were cleared. They weren't treated as banking. So, it shows you that they're trying to include, not exclude.
Yeah,
really.
they're trying to move.
Important point. Yeah.
That's good. Okay, good. So if we talk a little bit now we've talked about processes from an angel perspective. We've talked from a founder perspective, which is good. This is an interesting one. I'd love to hear your take on when you're dealing with some companies. So I had a company approach, and they basically went out and got SEIS and EIS as a process. So they've got it all sorted, but they weren't talking to no one, right?
Okay.
So there was no conversations done. They felt that they had to get this process done, first of all,
Right.
to be ready for the market. And I understand that to a point, but they had no conversations. Do you see that as a negative or a good thing?
It's not as useful as it could be. The timing is important because it's much better if your actual investment is quite close to when you asked for the advance assurance. It means you're going to get the approval quicker, and your investors are going to get their tax reliefs quicker, and everybody's going to be happy.
Yes.
It's not a bad thing, but it's probably better. Well, it's definitely better to wait until you know how much you need.
Yeah.
That you can demonstrate that need, and that you can actually raise what you have total revenue, because it can be problematic if you say, right, we need £1 million. Here's our plan. We haven't spoken to any investors yet, but we're going to raise £1 million, and we're only going to give 10% of the company for that £1 million. And they go out there and find that actually they're going to have to give a lot more for a lot less. Let's face it, it happens sometimes. So on that basis, if you then go back to the revenue, it's a completely different story. We only got 250,000. Then there is an issue about whether that advance assurance is technically valid, because the goalposts have changed so significantly. You said you needed it to grow your business. This was why you needed it to grow your business, and all of a sudden, you're changing the story. So the closer the picture is from a projection to reality, and the less time there is between them, the more likelihood there is going to be a problem.
That's exactly what happened, actually. So the founder put down that they were going to raise X amount, and then it turned out they were only going to get a little bit, and it created confusion, and then it took forever. So it did. So I just see people, some founders locally feel that they have to have that to be able to go out and have conversations, when actually it can be reversed. Go out, have those conversations, and then, as you say, once you're getting to the point, then you can go through that process. So that's really interesting.
I think, Gary, that comes to some extent from people's own experiences with revenue and different parts of the revenue, and the stories that are in the press all the time these days about how long it takes to get a phone call answered.
Of course,
those sorts of things, and you can understand why people want to go first, but realistically, the point is that this team, the venture capital team, in the revenue, are they have their way of working, which is independent of the rest, and they will do their best to turn things around quickly. And you can go to them a few weeks before your investment is due to complete, and almost all the time you can be certain of getting it back. And if there are any issues, if there are any difficulties, or any quirks, the important thing is to spell those out. Get those out up front and your explanation of them, and that again will make the process not only more robust, but it should also be quicker as well,
So, okay, so that moves us very nicely onto the next piece. So if we talk a little bit about some challenges, right? What are the core challenges you're seeing from an angel capacity and from a founder perspective when you've been doing this process for some founders? If we can just give some examples.
Okay. So the biggest difficulty, I suppose, that people have is kind of matching their expectations with the actual money that's out there, and the difficulties that individuals have in getting over the line. So, typically an investment round, particularly let's say a second investment round, is going to be quite difficult to put together, because there will be some investors from the first time around. Maybe they will want to follow on, maybe they won't. In other words, invest more or not. You'll have new people coming in who may have different demands that may clash with, the terms on which people invested initially, and there's a tension there. So I think the single most important way to get around this is to actually make sure that people on the team or advising the team have experience of these situations. The difficulties that the major difficulty that I've seen is when people have made promises to friends, to consultants, about what they're going to get. This happens a lot in terms of share options as well, for example, where people have an expectation when they go into something that they're going to get X% of the company, and then you start talking to a VC or an angel network or something, and all of a sudden their expectations are completely different about how much of the company they want, whether they want so-and-so as a director or not. And all of a sudden, you may have difficult decisions to make. There may be a team of 3 founders, and one of the directors your investors just don't like and don't want on the team, and that is brutal. That's a real challenge. So I suppose the main challenges are people challenges,
Mm-hmm.
really, aren't they? It's just about personalities. It's about team. It's about managing expectations, and including your own.
Yep.
So if you're a founder looking for investment, it doesn't matter how many episodes of Dragon's Den you've watched. The reality will not always be like that.
Yeah.
And, anybody who knows sort of what's happened behind the scenes on a couple of Dragon's Den
Yeah, it's very
episodes
different.
with companies there, they don't always come through.
Yeah.
There are various good reasons why it doesn't happen.
Yeah.
It's more complicated than that, but complication isn't really entertainment, as you're probably finding out right now. But anyway.
Amazing. Amazing. Okay, so just two more questions and then we'll close off. So being in this ecosystem and helping founders, right? How do you think the local knowledge is of these schemes, right? Do you think what can we do to get better to understand these? Hopefully things like this will help. It's been really tactical and really insightful, so it has, so thank you. But what do you think we can do more locally in the ecosystem? Because there's still a lot of new angels coming through that are trying to diversify their portfolio and they don't even know about this kind of asset class.
Mm-hmm.
And then from a founder perspective, it's just the complete unknown. So what can we do as an ecosystem to improve that?
I think, I have the perspective of having started this part of my particular career journey, if you like, about 15 years ago or so, I suppose. And so I have seen the development that there's been, and it's been fantastic, in terms of knowledge, in terms of experience. There had been very few buyouts, exits, and the people who were involved in those were in many cases really, really good about sharing their experience and knowledge, and still are doing so. It's the most important thing, I think, for everybody is just making sure that people know that they can ask the questions, that there are places they can go.
Yeah.
Like yourself, Gary. I mean, you're very open to speaking to people and answering questions about these things and steering people in the right direction if that's not necessarily you.
Yep.
And I think we all do that. Certainly all of us that are involved in this. It's not just about a job. It's not just about work. It's actually about the one thing possibly I haven't mentioned so far, which is really, really important to this, is just how exciting, how much fun some of this can be when it goes right.
Of course, yeah.
And seeing people who've got really fresh ideas and great energy and enthusiasm, and just give you a fresh perspective on the world, being involved in that is always a buzz. And, and so sharing the buzz, I suppose, sharing what you know, if it's mentoring people to some extent, whether that's a founder or even an investor, bringing people into angel networks, bringing people into environments. I have brought companies along to events before where the EIS Association, for example, where, so that they could see what other people were doing in terms of pitching and get a feel for how this worked, who the people were, and, that they were all human, and actually quite a few of them were either, based close to them or very contactable, but, just one link on LinkedIn or whatever away, or a quick WhatsApp,
Yep.
So that's the thing. And I think simply all we can do is keep banging the drum, keep passing on the messages, talking to people, explaining and being open to that.
Yeah.
And to be fair, I think, there are literally hundreds of people who are very open to that and are spreading the word. It's frustrating to think that there are, founders who don't at an early stage hear about SEIS, EIS, and what it can do for them. Yeah,
there definitely is quite a few of them. There's a lot that had slipped through the cracks of support. So there is, I think our ecosystem does come together really strongly. And I love that piece you say about the buzz, because that's what I love, just helping founders and whatnot. But I think we are getting better at it. And I think the more we have companies, as you said, go through the process and see success, that'll just filter back, that knowledge and whatnot of giving back. So
absolutely,
I love that a lot. So Maybe to close us off, David.
Okay.
One single bit of advice you would give to someone considering their first SEIS or EIS investment from an angel perspective, and then from a founder perspective.
Okay.
Just one bit of advice.
Right, from an angel, does it really have to be just one?
Well, okay, fine. Let's go. You can have two. You can have two.
Okay. Well, we'll say it. I've already said have fun. Okay. So
Okay,
we'll
yeah.
take that one as well.
Okay, fine.
Start small and find out. I think is the point. It is. It's one of those situations where there is a lot of knowledge and information and so forth out there, but nothing teaches you like actually getting your fingers dirty and trying it for yourself. And there are a number of ways of doing that, but the best thing is to try to get along to Angel Network meetings, talk to somebody you know who is doing a bit of this investment and is happy to talk to you about it. Most of them tend to be happy to talk about it. They may not tell you figures, but they will talk about experiences and so on, and do's and don'ts. So find out what you can, and start small. Don't put all your eggs in one basket.
No, definitely don't. Definitely don't. Definitely don't.
And always think of it as a long-term thing.
Yes.
Money that goes into shares of any kind, unless it's tradable FTSE index shares or something, is not liquid funds, and you can't get hold of it quickly. And you can't just sell your shares to the man next door. There's a shareholders agreement that says you're not allowed to do that. So once the money's in, it's there for it's there for a while. So just kind of don't forget about it, but don't come looking for it. And let's hope it just grows to the skyrocket levels that we
love it
for.
Love
so
it.
That's from the investor point of view.
And from a founder?
From a founder point of view, it is linked very much to what we're saying about find out, because one thing I didn't mention, Gary, and it is a really important piece of advice, is founders will probably always assume that they can't participate in SEIS and EIS reliefs, and for the most part they can't, because there's a 30% control cap on any company that you're involved in. So for SEIS and EIS purposes, so most founders, if there's only 1, 2, even 3 people in the team, and they're all equal, they're going to be excluded just by that very fact. But I have had situations, for example, where there have been 4 founders who have a good idea come together, and by getting 25% each at the start, they've invested a small amount, and it means that whenever their company makes millions, all of that is under is under the capital gains tax-free, the tax-free exit rules. Another one were 3 brothers, because normally family are associated with you for these. So, a father, a brother, a sister, a mother, all added together. So you can't split the 100% among 4 people like that if they're all related. But strangely, siblings don't count. So I've had a situation where 3 brothers have owned 90% of a company, and they've been able to get their SEIS reliefs to start it off. So, it's those things of, these are things you will read. You would have to read quite deeply to find them out yourself. So talk to somebody
brilliant
like me, like you.
Fantastic.
Like, somebody who's going to be able to either tell you or steer you in the right direction and get you thinking about those things that you probably wouldn't find out for yourself until it's too late.
Yeah. Amazing. David, that was fantastic. Really tactical and insightful kind of data points that people can use moving forward in trying to understand this world of SES and EIS. So I really appreciate your time. Thank you so much for this.
Not at all.